Imagine one of the world's largest tech companies, a leader in smartphones, chips, and screens, yet trading at a puzzling discount to its peers. Samsung Electronics sells more phones than Apple and is a memory chip giant rivaling Intel, yet its stock valuation lags far behind. Investors call it the Korea discount, a catch-all for why Samsung's market value seems lower than the sum of its parts. In this video, we'll explore whether splitting up Samsung Electronics could finally unlock its true worth and solve this valuation mystery. To understand the dilemma, we must first map Samsung Electronics' sprawling structure. The company is essentially four businesses in one: a device experience, DX, division making consumer products, smartphones, TVs, appliances, network, gear, etc. A device solutions, DS, ARM supplying components, memory chips, processors, etc. A display subsidiary, SDC, producing screens, and an automotive tech unit, Harman, building car electronics. In other words, Samsung Electronics combines the roles of Apple, phones and gadgets, Intel/TSMC, semiconductors, LG display, panels, and even an auto supplier, all under one roof. Such diversity is a double-edged sword. On one hand, it gives Samsung incredible scale and synergy. Its vertical integration, making many of the parts that go into its own devices, can lower costs and speed up innovation. For example, Samsung designs its Galaxy phone processors and can fabricate them internally, and it sources Samsung-made OLED screens and memory for those phones. This tight ecosystem is a strategic advantage that allows rapid product development and competitive pricing. But on the other hand, the mix is hard for investors to value. Each segment has different economics: high volume but lower margin gadgets, volatile cyclical memory chips, capital-intensive chip foundries, and niche automotive systems. Analysts argue that these parts, bundled together, obscure the true value of each. A fund manager noted that Samsung's world-leading OLED display and advanced chip foundry businesses aren't fully appreciated by the market because they're buried inside a conglomerate. The company trades at only approximately 1.5 times book value, lower than peers like SK Hynix, 3.2 times, or Micron, 3.5 times, despite its strong market positions. In short, Samsung suffers a conglomerate discount. The whole is worth less than the parts. Samsung's valuation woes aren't just about business mix. They tie into South Korea's broader chaebol, family conglomerate, governance issues. For decades, many chaebols were run with opaque governance and controlling families' interests first, often at the expense of minority shareholders. Historically, chaebols paid skimpy dividends and engaged in complex intra-group deals, which bred investor mistrust. This mistrust contributes to the Korea discount, depressing stock prices across the market. Samsung Electronics itself has been a poster child of both excellence and governance controversy. A vivid example was the 2015 merger of two Samsung affiliates, Cheil Industries and Samsung C&T, orchestrated to solidify the Lee family's control. Minority shareholders, like activist fund Elliott Management, protested that the deal unfairly undervalued Samsung C&T and benefited the heir apparent, Lee Jae-yong. South Korea's National Pension Fund, a large investor, was even pressured by government officials to approve the merger, a scandal that eventually landed a government minister in jail and contributed to the impeachment of a president. Such episodes underscore investors' fears that conglomerate governance can trump shareholder value. The lingering result? Investors apply an extra discount to Korean conglomerates, including Samsung, as a buffer for potential self-dealing or strategic maneuvers that might not prioritize shareholder returns. Samsung has taken steps to improve governance in recent years, boosting dividends, cancelling treasury stock, adding independent directors, which helped its stock climb out of past troughs. But the fundamental structure remains. The Lee family controls the group through a web of holdings, and Samsung Electronics must balance serving external investors with being the crown jewel of a family empire. This tension lies at the heart of the breakup debate. Many ask, if the Korea discount stems from conglomerate structure and governance, why not dismantle those structures? Proponents of a split-up make a straightforward argument. Shareholders would be better off if Samsung Electronics' major businesses were set free as pure-play companies. Here's the bull case for breaking up. Unlocking sum of the parts value. On paper, Samsung's pieces are worth more individually than the company's current market cap. If you valued its smartphone business, semiconductor division, display unit, and Harman separately using peer multiples, the combined value might exceed Samsung's one-size-fits-all valuation today. For instance, Samsung's foundry, contract chip manufacturing unit, is the world's number 2 after TSMC, with approximately $18 billion annual sales. TSMC's singular focus has won it a rich $1 trillion market cap. Samsung's foundry is smaller and currently less profitable, but if it were a standalone entity that investors could compare directly to TSMC, its valuation multiple could rise. Similarly, Samsung Display, SDC, holds approximately 50% global OLED market share, a dominance that might fetch a higher valuation if not lumped inside electronics. One analysis estimated that Samsung's equity value could be nearly double the current price under a sum-of-the-parts assessment, suggesting significant upside if hidden businesses are fully valued by the market. Pure play appeal. By splitting, Samsung could offer investors focused opportunities. Some investors want a pure memory chip play, like SK Hynix or Micron, without the volatility of phones. Others might invest in a standalone Samsung mobile or consumer electronics company if it were separate. Right now, buying Samsung Electronics is an all-of-the-above bundle. Pure plays often command higher valuations because their strategy, financials, and risks are easier to understand. For example, device companies and chip companies are valued differently. Separating them could attract specialist investors for each. A US fund manager remarked that once businesses achieve more transparent reporting or separation, their full value can be realized. But as part of a conglomerate, that value is discounted. Better capital allocation and discipline. In a conglomerate, strong units can mask or subsidize weaker ones. If each division were on its own, managers would be under greater pressure to perform without relying on group cash cows. Capital discipline could improve as each business raises and allocates capital suited to its industry, rather than Samsung's central coffers funding everything. For instance, Samsung's semiconductor arm has been pouring cash into the foundry business, an expensive long-term bet, aided by big profits from the memory chip cycle and mobile. An independent foundry company might invest more prudently or seek external partnerships instead of counting on the Samsung bankroll. Likewise, a standalone consumer electronics firm might be more cost-conscious and focused on shareholder returns, e.g. consistent dividends, once free of the growth mandate of the semiconductor division. Addressing conflicts of interest, foundry versus fabless. A key argument revolves around Samsung's foundry business, i.e., making chips for outside customers. Right now, Samsung's DS division houses both the foundry and Samsung's own chip design unit, System LSI, which designs Exynos mobile processors. This dual role as both chip designer and contract manufacturer has raised client concerns for years. Fabless customers like Qualcomm or Nvidia might fear that giving Samsung their chip designs for production could risk intellectual property leaking to Samsung's in-house teams, or that Samsung might prioritize its own needs over clients. Spinning off the foundry business would create a neutral, dedicated chip manufacturer, potentially attracting more external orders by eliminating that conflict. Trust is critical in the foundry business, an industry source emphasized, noting that clients want assurance their designs won't end up helping a competitor. A hard promise when your manufacturer, Samsung, also competes with you in chips. An independent Samsung foundry company could even list on an overseas exchange, like Nasdaq, as some have suggested, to draw global investors and benchmark directly against TSMC. Global benchmarking and governance boost. If Samsung's units were separated, they could pursue listings or partnerships that might have been impossible under the giant umbrella. For example, a standalone Samsung foundry might seek a strategic partnership or equity tie-up with an overseas player. There have even been speculative whispers of a joint venture with Intel or TSMC in foundry. Being separate could also allow a business to adopt more tailored governance. It's notable that even Samsung's own financial arm, Samsung Securities, recommended in a 2022 report that Samsung consider carving out the foundry and listing it in the US to unlock value. Activist investors in the past have pushed for structural moves. Elliott Management in 2016 proposed Samsung Electronics split into a holding company and an operating company, and even weighed a Nasdaq listing for the latter to improve corporate governance and valuation. A breakup aligned with such ideas could earn Samsung a re-rating by proving it puts shareholder value first. Precedents in Korea, SK and LG's moves. Samsung wouldn't be the first chaebol to reorganize for value. In 2021, telecom operator SK Telecom spun off its investments and semiconductor holdings into a new entity, SK Square, explicitly to maximize value for shareholders. The logic was similar. SK Telecom's core phone business was being undervalued partly because it held stakes in tech assets like chipmaker SK Hynix. By creating SK Square as a separate tech investment company, the market could properly value those stakes. Indeed, SK Square's stock soared after listing. Its market cap more than tripled within a year, from approximately 10 trillion won to over 30 trillion won, suggesting that unlocking effect in action. Meanwhile, LG Group in 2020 spun off LG Energy Solution from LG Chem. LG Energy, focused purely on EV batteries, attained a 70 trillion won valuation, approximately $59 billion, at its IPO, instantly becoming a top global battery player. This carve-out was meant to unlock value and fund growth for the battery unit. Investors flocked to the pure-play battery stock, which fetched rich multiples reminiscent of Tesla's supply chain boom. These examples provide a playbook. Breaking out high-growth or core units can attract investor enthusiasm and capital that conglomerates might not capture. Higher profile and strategic flexibility. Separate listings could also raise the profile of each business. For instance, an independent Samsung semiconductor company might be big enough to join global semiconductor indices, drawing index fund investments. A standalone consumer electronics firm could pursue mergers or alliances, perhaps with other appliance or CE companies, without worrying about how it fits Samsung's group strategy. Essentially, each piece could pursue its optimal strategy, whether that's aggressive expansion with external funding, chips, or steady returns and innovation, consumer devices, and be judged on its own merits. While breakup cheerleaders make a compelling case, there are equally strong counterarguments. Splitting up a giant like Samsung Electronics is not a cure-all and could introduce new problems. Here's the case against a breakup. Synergies and scale advantages. Samsung's integrated model provides tangible benefits that might be lost if the company fractures. The various divisions often work in tandem. For example, Samsung's phone designers collaborate with its component engineers to fine-tune hardware, say, optimizing a Galaxy handset to use a new Samsung memory chip or display for best performance. Such vertical integration can shorten development cycles and yield superior products. Samsung's ability to share knowledge across semiconductors, software, and hardware is a competitive edge. Economies of scale are also significant. As one large entity, Samsung can leverage bulk purchasing, combined supply chains, and a unified brand. A breakup might create smaller entities that have less bargaining power with suppliers or fewer resources to invest in R&D. Apple, while not a conglomerate, famously benefits from vertical integration of design and tight coordination with suppliers. Samsung's internal version of this might be weakened if each part becomes independent. In short, the whole Samsung might indeed be greater than the sum of its parts when it comes to operational strength. Loss of diversification buffer. Samsung's breadth acts as a natural hedge. When one business is down, another may be up. For instance, a downturn in memory chip prices, which happened in 2019 and again in 2023, hurts the DS division's profits. But at the same time, the smartphone and appliance sales in DX might be doing well, softening the blow. As a single company, Samsung can endure industry cycles by relying on this internal diversification. If broken apart, each business becomes more exposed to its cyclical risks. A pure memory chip company would face gut-wrenching profit swings. A standalone phone maker would be vulnerable if it misses a product trend, etc. Some investors actually like Samsung because it's a one-stop exposure to multiple tech industries, providing a balance that a pure play lacks. The conglomerate structure, critics say, is akin to an internal mutual fund that smooths volatility. capital and cash flow sharing. Relatedly, the integrated structure lets Samsung funnel cash from stable units to invest in future growth areas. The recent example is Samsung's aggressive capital spending in semiconductors, building new chip fabs and R&D in cutting-edge 3-nanometer processes, funded in part by profits from mobile phones and consumer electronics. Samsung Foundry has been losing money for 2 years, trying to catch up to TSMC's technology. Within Samsung Electronics, that's been tolerable because the profitable memory business and smartphone sales offset those losses. If the foundry were on its own, running in the red, it might struggle to justify huge capital expenditures or even to stay financially afloat during down periods. One professor noted that now is too early to spin off the foundry because it lacks a stable revenue stream and is not yet profitable. It first needs to win more clients and get into the black. In other words, Samsung's other divisions effectively incubate and support nascent businesses. Breaking up could cut those lifelines. Each new standalone company would have to fund its own investments or survive downturns without the conglomerate's deep pockets. Tax, legal, and execution hurdles. A corporate breakup is easier said than done. Spinning off units can trigger hefty taxes, require regulatory approvals, and entail complex reorganization of assets and intellectual property. South Korea's legal framework and tax code would influence how a Samsung split could be executed, and it might not be tax-free. Additionally, the Samsung Group's cross-shareholdings, Samsung Electronics is intertwined with Samsung C&T, Samsung Life Insurance, etc., in the family's control web, complicate matters. Untangling these could be like disassembling a puzzle that's been built over decades. The Lee family might need to reshuffle holdings to maintain control of separated entities, potentially incurring ownership dilution or further taxes, especially given Korea's high inheritance and capital gains taxes. Simply put, a breakup could cost billions in one-time expenses and take years to implement, during which time business momentum could suffer. Consumer and brand considerations. Samsung's brand is globally recognized and stands for a broad range of products, from phones to TVs to refrigerators. A split might require rebranding some units, causing consumer confusion or loss of brand equity. Imagine if Samsung phones and Samsung TVs were suddenly made by different companies that might even compete for the trademark usage. The conglomerate brand umbrella provides trust and marketing efficiencies when entering new businesses, e.g. Samsung, launching a new smart home device benefits from the TV and phone brand reputation. A breakup would need careful brand strategy to avoid undermining this unified perception. Some customers might also feel less assured about a smaller spin-off's reliability versus the big Samsung backing it. Vertical integration, strength. Samsung's internal supply chain can give it an edge in cost and time to market. For instance, Samsung Display, SDC, often develops cutting-edge panels that Samsung Mobile can adopt faster than competitors. If SDC were a separate entity, it would likely still sell to Samsung's phone division, but the coordination might be less seamless than when they are under one corporate roof. Likewise, Samsung's memory business often coordinates with device teams to anticipate future needs, like new memory types for next-gen phones. Severing these units could introduce more transactional relationships in place of collaborative ones, potentially slowing innovation. Cultural and political resistance. A less tangible but important factor is the cultural significance of Samsung in South Korea. It's not just a company, it's a national champion and a source of pride and economic security, employing tens of thousands and driving exports. Any move to break it up could face political scrutiny or public skepticism. Regulators and government leaders may prefer Samsung remains robust and integrated to compete with Chinese and American rivals on all fronts. The prevailing sentiment might be that an intact Samsung is better for Korea Inc.'s global competitiveness. Additionally, internally, Samsung's corporate culture is famously cohesive, even militaristic, under the late chairman Lee Kun-hee. Long-time Samsung managers rotate through different divisions, contributing to a shared identity. Breaking the company apart could hurt morale or lead to talent drains if employees feel uncertain about the future of spun-off entities. The Lee family itself, which has guided Samsung's empire for generations, has little incentive to voluntarily dismantle what is essentially their life's work and legacy. Lee Jae-yong, J.Y. Lee, the current de facto leader, has explicitly said he is not interested in spinning off core businesses like the semiconductor units, emphasizing a focus on growth under the existing structure. This top-level reluctance is a major roadblock to any breakup plan. Success is already being rewarded, somewhat. Those against a breakup might argue that Samsung has managed to narrow the valuation gap through incremental reforms and simply through success. Samsung Electronics stock has risen significantly in 2023 to 2024 as memory chip markets recovered and as the company ramped up investments in AI-related chips. It now trades at around 15 times forward earnings, higher than in years past, when it was under 10 times, showing that global investors can reward it despite the conglomerate structure. Perhaps continued improvements in transparency, dividends, and growth initiatives will further erode the discount without needing a radical split. In other words, if it ain't broke, don't fix it. Samsung is already one of the world's most valuable companies, $450 billion market cap, and is catching up to peers in certain metrics. Taken together, the counterarguments warn that a breakup could disrupt Samsung's competitive advantages and create new costs and risks. The company's ability to leverage synergies, fund big bets, and present a unified global brand might be impaired. Furthermore, any theoretical valuation gains could be eaten up by execution costs or diminished if the separated companies stumble without the conglomerate safety net. There is also the very real issue that those in power at Samsung, and possibly in government, may simply refuse to countenance a breakup, regardless of investor clamor. To gauge what might happen if Samsung splits, it helps to examine peers that have undergone reorganizations. SK Group's restructuring. As mentioned, SK Telecom's spin-off of SK Square in 2021 is a notable case. SK Telecom's core telecom business was steady but slow-growing, while its stakes in tech, like SK Hynix, were high-growth but undervalued inside a telco. By separating them, SK unlocked value. Shareholders of SK Telecom received SK Square shares, and the combined value of SK Telecom plus SK Square soon exceeded the pre-breakup value. SK Square aggressively pursued its own strategy, investing in chips, e-commerce, etc., and its market cap jumped by over 200% in 1 year, reflecting investor excitement for a focused tech holding company. Meanwhile, SK Telecom, free of those holdings, could refocus on telecom and new AI services. This suggests that a well-planned spin-off can indeed grow the pie for investors. The parts become worth more than the whole was. One reason is each entity gets its own management attention and investor following. If Samsung were to emulate this, one could imagine a scenario where, for example, a Samsung Semiconductor Co. is spun out. It could get a fresh evaluation by tech investors and perhaps trade at a higher multiple than it effectively does within Samsung Electronics today. However, one must also note that SK Group's situation involved a simpler parent-subsidiary relationship and a holding company structure, whereas Samsung Electronics breaking up would be more complex. LG Chem and LG Energy Solution. LG Chem's decision to carve out its battery division in 2020 offers a two-sided lesson. The spin-off, LG Energy Solution, LGES, was a blockbuster. Its IPO drew record demand, and it debuted at a market cap of $70 trillion, approximately $59 billion. LGES instantly became the world's second-largest EV battery maker by market value, validating the idea that investors will richly value a pure play in a hot sector. However, the parent LG Chem stock didn't soar in response. In fact, it lagged. Even after the IPO, LG Chem's remaining business, petrochemicals and materials, traded at a valuation below the value of its 82% stake in LGES, implying the market ascribed nearly zero value to the legacy business. This outcome highlights a pitfall. A spin-off can create a superstar and a rump. In LG's case, the shiny battery business got all the love, while the old chemicals business was neglected by investors. Applied to Samsung, skeptics wonder if, say, a spun-out semiconductor unit might thrive, but the leftover parts, or vice versa, could end up undervalued or struggling. It's a caution that breakups don't automatically unlock value for every piece. You need strong narratives for all resulting entities. International tech giants. Outside Korea, There's a trend of conglomerates streamlining. General Electric, GE, an iconic American conglomerate, decided in 2021 to split into 3 separate companies: aviation, healthcare, energy, after years of a conglomerate discount on its stock. The rationale was exactly to allow each to shine and be valued on distinct merits. IBM, another example, spun off its IT services arm, Kyndryl, in 2021 to focus on core cloud and software. And looking specifically at the chip industry, AMD, Advanced Micro Devices, a Samsung competitor in chips, albeit smaller, famously spun off its manufacturing division in 2009, creating Global Foundries. At the time, AMD was an integrated device maker like Samsung or Intel, but struggling. By shedding its costly fabrication business, AMD slashed expenses and focused on chip design, a move credited with helping it survive and later thrive. Now AMD is a successful fabless designer, while Global Foundries runs independently. Intel has also been under pressure to consider separating its foundry or manufacturing operations as it opens them to outside customers. The chip industry seems to be moving towards specialization. The foundry model, pure manufacturers like TSMC, versus fabless designers like Nvidia, Qualcomm, with few trying to do both. Samsung is one of the last big holdouts as a vertically integrated player in semiconductors. The question is whether sticking to that integrated model is a strength, as Samsung believes, or a weakness that a split would fix. Intel's exploration of a foundry carve-out, reports suggest it's weighing spinning off its fabrication unit, or at least running it more independently, indicates that even the mighty Intel sees some merit in a structural shift to stay competitive. Let's indulge in a simplified thought experiment on Samsung's sum of the parts valuation. Imagine Samsung Electronics were split into 3 companies: Samsung Devices and Experience, smartphones, TVs, appliances, etc., Samsung Semiconductors, memory, foundry, chip design, maybe including Samsung Display since displays are semiconductors of a sort, and Harman International, automotive tech. The devices business, smartphones and consumer electronics, had about 122 trillion won in sales in 2022, combining mobile and consumer electronics segments, and a stable profit of $7 billion from smartphones alone in a recent year. This could be viewed akin to other consumer tech firms. Apple, an outlier with ecosystem lock-in, trades around 30 times earnings, but other hardware-focused firms trade lower. If we apply, say, a 15 times PE to Samsung's approximately $10 billion normalized consumer electronics earnings, phone plus TV appliance profits, that yields approximately $150 billion valuation. This is rough, but it signals that the Samsung consumer division might be worth on the order of $100 to $200 billion as a standalone, given its global scale number 1 TV maker for 19 years running, number 1 or number 2 in phones. The semiconductor and display business is trickier due to cyclicality. Samsung's memory chip business has historically been extremely profitable. In peak years, memory contributed the majority of Samsung's entire profit. Samsung's share of the memory market is approximately 40% in DRAM, market leader, and approximately 30% in NAND flash, comparable to Intel's former dominance in CPUs. A pure memory company could be benchmarked to SK Hynix or Micron. Samsung's memory operation is at least as large as SK Hynix, and often more profitable per unit due to scale. So one could argue Samsung's memory arm alone might be worth $200 billion, depending on the memory cycle. Now add the logic foundry side. Samsung's foundry is the number 2 globally and had approximately $18 billion revenue recently, but is near break-even profitability at best for now. If it were valued like TSMC, which is highly profitable, it could be huge, but given its struggles, perhaps it would be valued more like an promising turnaround project. Still, even a fraction of TSMC's valuation could be tens of billions. Samsung's system LSI chip design unit effectively makes it a peer of fabless companies. If spun out, it could be Korea's Qualcomm. Add in Samsung Display, SDC. It's wholly owned and generates about $20 billion revenue with dominant OLED market share. LG Display, a competitor in panels, has a market cap around $5 billion, though LGD has been loss-making recently. SDC, with presumably better margins, thanks to OLED leadership, could be worth more. Maybe on the order of $8 to $10 billion or higher if the OLED market grows. And considering SDC supplies Apple with iPhone screens, a pretty critical role. Summing these, a Samsung semiconductors and display company could plausibly command $200+ billion, memory, plus perhaps $30 to $50 billion, foundry and logic if valued on future potential, plus approximately $10 billion, display, equals on the order of $250 to $300 billion in an optimistic scenario. That alone is a huge chunk. Harman and other lesser units. Harman, acquired for $8 billion in 2017, is a leader in car infotainment, audio, and connected tech. It's grown since and made further acquisitions, like automotive audio brands. Standalone, Harman might be comparable to other automotive electronics suppliers, perhaps worth in the ballpark of its acquisition price or more if you factor growth, say $8 to $10 billion. It's relatively small in the Samsung universe, approximately $3 to $4 billion annual sales, but not insignificant. Now, these back-of-the-envelope numbers are speculative. But if we add them up, $150 billion, devices, plus $200 to $300 billion, semis, display, plus approximately $10 billion, Harman, equals roughly $360 to $460 billion. Samsung Electronics' current market cap is around $450 billion after a significant rally. The key takeaway is not the exact number, but the realization that investors cannot currently invest in these pieces separately. They get Samsung as a package, whether they like all parts or not. If those who love the chip business could invest in Samsung Chip Company, and those who love the consumer brand in Samsung Consumer Company, the argument goes, more capital would flow in overall. It's about choice and clarity, two things markets tend to reward.